Welcome back, friends. Israel's strikes against Iran today have threatened to reignite a regional conflict that disrupts oil supplies across the Middle East, with traders reviving the decade-old question of whether Tehran could respond by closing the vital industry choke point at the Strait of Hormuz. Brent crude, the global benchmark, has surged 12% in a high of 78 before retreating to $76 today. After Israel launched dozens of strikes against Iran's nuclear program and military facilities, killing at least two top commanders. Prices have fallen a little bit since then, as it became clear that Israel has stopped short of targeting Iran's oil infrastructure, but traders believe that prices could move significantly higher depending on how Tehran retaliates to the Israeli strike. The market is reasonably calm because the Israelis chose not to target oil infrastructure. But if you are Iran, you know that that's the Achilles heel. After about 21 million barrels of oil from Iran, Iraq, Kuwait, Saudi Arabia, and the United Arab Emirates pass daily through the narrow waterway which is separating the Islamic Republic from the Gulf states, representing about a third of the world's seaborne oil supplies. Iran has repeatedly threatened to close the strait in the event of an attack, but has never been able to block all the traffic as yet. Although it is a pinch point for flows of crude, the Strait of Hormuz is still 35 miles wide at its narrowest point. A closure of the strait, though it is unlikely at this point of time, would represent the most extreme action that Iran could take. While the US troops in the region would promptly react and reopen the strait, this would push Brent prices way above $100 a barrel threshold if it actually were to materialize. Given the presence of the United States Navy's 5th Fleet in Bahrain, in Halima, you find that it would make it extremely difficult for Iran to close the strait completely for an extended period of time. Tehran could launch attacks on tankers to disrupt the traffic, as it did during the Iran-Iraq war in the 1980s. However, such a step would also disrupt the more than 1 million barrels per day that Iran exports to China. So China is amongst the only countries which is currently taking Iranian oil. While Iran and Israel exchanged airstrikes in April and October of 2024, it was Iran that struck first, with Israel retaliating. Now this time it's just the other way around. Sequence has reversed, a shift that could significantly influence market expectations and risk perceptions. If Iran disrupts oil flows to the Strait of Hormuz, then targets regional oil infrastructure, or strikes US military assets, it could push prices up by $20 per barrel or more. Some of the world's largest oil fields, including in Saudi Arabia and in Iraq, are within reach of Iran's missiles and drones. In 2019, Iran was widely believed to be behind a drone attack on Saudi Arabia's largest oil processing facility that temporarily cut the kingdom's crude production by more than half and briefly pushed up global oil prices as much as 20%. All this may be a knee-jerk reaction, but something to keep in mind. However, the restoration of diplomatic ties between Riyadh and Tehran in 2023 has made a repeat attack on Saudi Aramco's oil facilities less likely. The dynamics between Iran and Gulf states have changed over the past few years. An alternative scenario might see Israel escalate its assault by targeting Iran's vital Kharg Island terminals, which are responsible for 90% of the Islamic Republic's oil exports and the primary source of funds for its government and nuclear program. The prices, which remain below levels earlier seen this year, like $80 plus, before the President Donald Trump launched its blitz of global tariffs would be much higher if the markets became convinced that direct attacks on oil infrastructure were likely. The correct price for oil is almost certainly not where it is today. The fundamentals of supply and demand tell you that the price should be lower by $10 or more, considering the weak economic outlook outlined by the World Bank just about a week back. The risk premium, if you need a risk premium, probably should be $10 higher on a geopolitical risk basis. Before this week's military escalation, oil prices had generally been falling since March, pushed lower by expectations that Donald Trump's tariffs will hurt demand and the OPEC Plus cartel's decision to accelerate the unwinding of long-standing production cuts. Saudi Arabia-led producer group has already agreed to restore up to 1.4 million barrels a day of idle capacity between April and July, and it is on course to increase the group's headline production by another 800,000 barrels per day between August and September. In the event of a major disruption, for example, to the Iranian supply, most traders expect that OPEC would move to increase production even faster. In theory, the group still has more than 5 million barrels per day in idle capacity to bring back online. However, it is too soon for any discussion of drawing from emergency stocks at this point of time. And you should also know that most nations, including the United States, have got a strategic oil reserve, which they can also utilize in the event of a major attack by Iran on the oil production facilities in various parts of the world that I just explained. OPEC affirms that there are currently no developments in supply or market dynamics that warrant unnecessary measures. So friends, this is where we stand at this point of time. Oil is over $70 a barrel, and we await further developments on the Israel-Iran war. I believe that we have not heard the last, and there is every possibility that Iran this time may go and either disrupt oil production by attacking certain facilities or go near the Gulf of Hormuz. What shape it takes, it is going to be very crucial over the next few days and weeks. I believe that we have not heard the last from Iran, and much more is yet in the offing, which can impact oil prices, global production, global economy, and global stock markets. To get to know the timeline when all these can get impacted and by what quantum and magnitude, do join our Prime Plus Telegram group, which are addressed specifically for the US markets. For the Indian markets, you can join Premium Plus, which gives you 10 to 12 days predictions of the Indian markets, plus some very good multi-bagger stock suggestions, which you can buy when the markets are ready to welcome you. And we will tell you far in advance, so you're well prepared and well dressed for success in the days, weeks, and months to come. Have a nice rest of the investing day. Take care. God bless you all. And yes, in order to join our US Telegram group, you can WhatsApp us on 732-732-2720 for the Indian markets. You may WhatsApp us on 982-086-1044, or you can alternatively also email us at globalmoneyinvestor@gmail.com. globalmoneyinvestor@gmail.com. Happy investing and have a nice rest of the investing day. Take care. Bye-bye.